Jerry, did you have any questions as you were calling through and talking to clients? Were there any things that you thought people were wanting to hear about today?
I think there was some general concern that the unemployment situation, that we'd actually start to see the effects of that, after July into August, potentially, as the stimulus package essentially gets used up for those 2 months that it was kind of planned for.
Okay.
So a few people talking about that.
Okay.
Hard to know exactly how that will pan out.
Oh, exactly. And then Amber, did you have any questions that you'd like me to make sure that I address as we go through this this evening? Looks like she's probably got me on mute or is distracted. So we'll get going here in a few. Got a few more people trickling in here. Hello, Enid.
Hey, boss. How's it going?
I am good. I've got my bright lights and got the stand-up desk tall here and got some good information. Everything kind of came together.
Got your pose on?
I think so.
Nice. I've got my drink on, so I'm all set to be supportive.
I've got my drink. I've got my sips. I've got my tips.
That's good.
All right,
probably healthier.
We'll give it 2 more minutes, and then we'll go. I'll see if I can manage multiple screens this time.
Nice.
Trying to think of what exciting happened today in real estate. Nothing much other than the statistics look good for the month of May. And looks like we're going to have a good June. So,
any word on when phase 2 will come about and what that means?
That is well above my pay grade. I know what it looks like when it happens, but it means that we can have more people inside of houses and things like that. But no, well above my pay grade.
Cool.
All right, well, we'll get going for now. Hopefully, it looks like everything is happening on Facebook. So we're sharing that live. That's a success versus last time. Yeah, and we'll just get going. So all of these, the reason that we do these sips and tips is to help folks move through the pattern that we advocate for real estate, which is the idea of just increasing that level of ownership and investment that real estate gives you over time. So what we want to do tonight is talk to you about real estate market update. I know that a lot is changing in this world right now, so we want to share that information with you. We also want to talk to you about the mortgage market, because that is definitely affecting everything that's going on these days. And then we're going to talk about, since all of us spending more time at home, we have the opportunity to improve our homes, or at least think about it at the moment. So we're going to talk to you about how to get the best out of what you do to your home, both in the short term and the long term, and then talk a little bit about some of the things as we look at how our world is changing in the short term and the long term. What is it that you can do to your home to make it work for some of these short-term and long-term changes that we might see? And most importantly, we're here to answer your questions. So if you've got questions, just jump right in, and would love to answer them. Okay, so whenever we look at the market, I like to think of it as, where are we? You know, where are we at right now with the market? And we always look at some major metrics. And then I want to talk to you about what's different in today's market, because the interesting thing is when we look at the major metrics, we're not going to see a whole lot of change versus what we might have expected a year ago. And then I want to talk to you about interest rates and what that means for buying power. So the major metrics of real estate: inventory. I was talking with a client earlier today, and they were asking about just this, and I told them, you know, the interesting part of real estate is the way that it feels to you is all about inventory, the balance of buyers versus sellers. And right now, what you're seeing is that at least in the last month, from April to May, nothing really changed. We've got 1.4 months of inventory, which is absolutely a seller's market. It's more inventory than what we saw at the beginning of the year, but the beginning of the year is typically always going to be on the lowest side of inventory. Either it tends to be really high or it tends to be really low. Either we kind of sell out before the holidays and people are off the market, or we have a lagging sort of market throughout the holidays and a bunch of properties stick on. So January is kind of a throwaway month to me. But when we look at last year this time, we had 2.3 months of inventory. So we actually have a more constrained, more seller-favored market right now than what we did last year, which is just interesting. I don't know that it's good or it's bad. It's just interesting. When we look at days on market, how does it feel if you're in the market right now as a seller? Feels pretty darn good. Last month, you sold in about 5 days. This past month in May, you sold in about 7 days. So, that's a couple of days more, and, people are going to make headlines with that because if you add 2 to 5, that's a huge percentage increase, but the practical increase between 5 and 7 days really isn't that much for sellers. So overall, feels pretty good compared to this time last year. We're awesome. And compared to 10 years ago when the market was not what it is today, but the economy was kind of looking similar, we're doing much better. 10 years ago, 2010, we were back at plus 30 days on market on average. So there was a lot of people who were experiencing, 30, 45, 60, 90 days on market before they got sold. What most people are most interested in, right, is median home price, right? And it's the value of their home. So the interesting thing is we look at between May and April, we actually decreased a little bit in median home value in King County. We actually saw that we went from $650,000 median home price in April down to $625,000 in May. And we did the same thing in Snohomish County. And a lot of people would be, whoa, hold on a minute, that's kind of scary. And it might be, with the exception of when we look at the mortgage market, one of the things that banks have done as the crisis has unfolded is to become more conservative, right? They want to save their capital so that they can live and they can help other businesses live. And so what that's meant in the mortgage market is that jumbo loans, generally for purchases that are above $850,000, $900,000 and more, are much more difficult to get. So you're seeing fewer homes sell at that level, which means naturally you're going to see median home prices go down. I like to look at it, if you look down the neighborhood, right? If you've got homes in the neighborhood, you haven't seen home prices go down. Home prices will not go down when there are inventory levels of 1.4 months and homes are selling in 7 days. They just don't go down. If anything, they go up. However, if you're shopping in that 1.2, $2 million, $3 million price range, that may be where you can find some deals. So why jumbo loans? I was trying to do something fun with this, but clearly I missed my choreography. Now, so we look at what's the difference. Like I said, the major metrics would lead us to believe that not a whole lot has changed in this world versus what we might have expected a year ago. And yet we know that the world has substantively changed versus a year ago. So the big thing that we look at is not necessarily the feeling of the market, but rather the volume of the market. We're just seeing less activity out there. What you're seeing right now, new listings in the month of May, down 33% versus this time last year, right? So we're down a third on new listings. When I talked earlier before we got going about how I've got hope for a great June, right? What we're seeing right now is that we've got pending sales are actually only down by 10%. Now you see that big divot over here in the month of April, right? Normally what we see almost every year is this bell curve of pending sales. Pending sales hit their bottom generally in the month of January, and then they go up and they hit their peak somewhere between May, June, and July, right? And then they tail off towards the end of the year as people don't want to move their Christmas trees and their turkeys and stuff like that. But this year you saw that little divot in the month of April, and then now we're back up in the month of May. And that's going to certainly help us out on closed sales, where you see closed sales were down and were flat. They went down in the month of April and then flattened out further in the month of May. But you look back at the idea that our pending sales are only down by 10% versus what we would expect last year. And I think what you're going to find is the month of June, we're going to see that rocket back up and probably have a difference of maybe only 20% compared to where we were last year. So just look for that overall. So right now, volumes are just lower. You're just seeing less people out there buying, less people come into the market selling. And Enid had asked the question earlier, what does real estate look like when we get to phase 2 and even phase 3? And I know that phase 2 means that we can just be more active. We can have multiple buyers out with us in homes. We can have a buyer and an inspector out there. Just the market frees up a bit and is a little bit more active. And what I would expect out of that, and what we've been seeing, and I was at a listing meeting earlier today where they were saying, hey, we want to get on the market before all of these other homes that we're seeing in the neighborhood, right? Because they're seeing their neighbors get their homes ready. And we believe that what you're going to see is a blossoming of inventory as we get to that phase 2 and phase 3. Any questions about just the real estate market overall right now? Hearing none, I'll move forward. Robert's Rules of Order. Interest rates, I think, are the most phenomenal thing right now. And if you look at if there's one thing that's really kind of keeping real estate going, it is the fact that despite the fact that we have high unemployment, we also have, because of our regional economy being so tech-driven, we also have a lot of people who are still employed, working from home, and they're taking advantage of interest rates, which are on average 3.15%, right? And I know that for us, it's one that we bought a home a few years ago and got a mortgage at 3.8%, and I thought that was phenomenal, right? And we recently are in the process of refining, and we just locked today, and it's 2.875% is what we locked at, which is just like unheard of. I know that when we were talking with Jill Bartoletti, our loan officer, she was saying, like, this is the last mortgage you're ever going to have on that house. And I pretty much agree. I'd be shocked if it went any lower than that. Now, what does that mean practically? I know that, these low interest rates, can, seem like small numbers, but they have a really large impact on your buying power for a monthly payment, because most people out there, they don't go out there and buy a specific interest rate. They don't go out there and buy at a specific price point and say, I've always wanted to own a $500,000 house or $1 million house. What they look at is their monthly budget and say, well, I've got $2,000, $3,000, $4,000 a month for my housing. This is how much will this buy me, right? And what we know is in May 2020, a $2,000 principal and interest payment for a mortgage will buy you $465,000 of purchase power, right? You compare that to 2010, that would have only gotten you $382,000. And that rate wasn't that bad. If we go back to it, that rate was what? 4.75%, still about 2 to 3% lower than our 50-year national average for interest rates, right? So we're just doing phenomenally on this. And so right now, if you've got a mortgage on your home that has an interest rate of more than about 3.75%, right, it would probably be a good idea to at least check into refinancing, especially if you're planning to live in that home for more than 2 or 3 years. I know that our break-even point, when I looked at our refi, we're saving about a point. It's going to take us, I think, about 6 months to pay back the costs of refi, which, given the fact that it's a 30-year mortgage, I'll take that deal any day and twice on Sunday. Okay, so conclusion on the market. I believe the market is healthy in spite of the broader economy. Certainly have some broader economic concerns out there, and we're just gonna have to see where those go, right? How quickly we recover. Everything that we hear right now, well, not everything, much of what we hear from economists is this is going to be a V-shaped recovery. So steep down and steep back up. But I would also say if those economists were always right, they probably wouldn't be economists on TV and in paper. They'd probably be sitting in a Bahamian resort right now, socially distanced with a margarita, of course. The other thing that we know is that we've got a seller's market, right? Is that it's a good time to be a seller. Normally when it's a good time to be a seller, it's not always the great time to be a buyer. And right now it's not the best time for buyers simply because there isn't a whole lot of inventory to choose from. But the inventory that you have less people that you're competing with than you did a year ago, which that's kind of nice. And it's more affordable than it was a year ago. And it will save you literally tens, if not hundreds of thousands of dollars over the lifetime of ownership of that property because you've got such low interest rates. And then the final thing is we expect stability in the real estate market here regionally, principally because we have had a lack of inventory, a lack of home building that has been quite substantial relative to the immigration of people to our region for the last 10 years. Right? So that lack of inventory, just taking all the people who would like to own homes in our area and just letting them buy homes over the next few years will likely fill in any gaps that we have of available inventory if we see it increase by 2 or 3 or 4 months. So we look at it from the perspective of we might not have that huge price growth that we've seen over the last few years, but we do expect to have a plateau or very little regression and probably just a slight increase in home prices over the next few years. All right, any questions about that? All right, hearing none, I'm going to move on to...
Sorry. I was just trying to give other people a chance first.
Okay.
But I do have a question about mortgages.
Yes.
Because the interest rates are so low and it's a great time, everybody's home looking at their finances and taking advantage. What's the backlog like? Did Jill ever give you some insight into if it's even feasible? Are the mortgage companies overwhelmed with applications? What's the likelihood of this working out well or being able to lock in a rate and actually have it close in time to maintain that rate?
Yes, generally when you lock in, once you've locked in a rate, you're going to be golden, right? In terms of that mortgage company. What we are seeing, and one of our judgments of mortgage companies is that they do prioritize purchasers because purchasers have a contract that's associated with the back end. So failure to meet a date could be very profound for them. Versus when you're refining, right? Failure to meet to get us refied this month versus next month. Yeah, I'd like to refi sooner than later, but it's not going to cause a loss of a home or something like that. I might lose a couple $100 because I didn't get my better mortgage this month versus next month, right? I know that yes, mortgage companies are backlogged, especially with refinances right now. So I would encourage 2 things if you are looking at refinancing. The first one is patience. Right? Be patient, get a good professional who communicates well with you, but be patient with them. They're going to work the system as quickly as they can. And then the second thing is, like we always encourage, when they ask you for something, if you want it done quickly, respond quickly, right? You know, I know that for us, it's one of those, I've got a list of like 8 things that I've got to provide, and I'm going to make sure that they have it tomorrow because I want to get this done. Because if you start to slip down that pile, if they're professionals, they're going to handle things as quickly as you get them to them. So that would be my advice. But if you're also, last thing that I would say is try not to deal with call centers, right? So if you've got somebody if you've got a mortgage company where you reach a different representative every time, you might save a little bit of money. My doubt is that you will, but you're probably going to have a bumpier ride through that process.
Do you think that any of the mortgage forbearance options that have been given to people during this time have had any sort of impact on mortgage lenders or anything that would impact our ability to refinance or purchase a home?
That is a great question, and I will do my best to give you a 90-second answer, which is it's changed quite a bit. So when we first got into forbearance, and we first started having this discussion, it was roses and candy, right? They were just all, hey, everything's going to be fine. Just get into forbearance and life is fine. What you started to unpack from that is that while they weren't reporting negatively on your credit, they were reporting actuality on your credit, which is to say, if you're in forbearance, you're not actually making payments. And so they're just going to say that you haven't, there's going to be something on your credit that's going to show that your balance did not go down that month. And the systems are smart enough to know that that means that you're not making your payment. And then what that ended up meaning is that you are unlikely to be able to qualify for a new loan. Now, I think that's understandable, right? If you're not paying your current debt, right, they may not want to give you new debt,
Mm-hmm.
right? Now, what I know is that the feds have come out and essentially said, hey, if you can show that you can pay this new debt, at least Fannie and Freddie loans should allow you to refinance, especially given that that should help you improve your ability to maintain that debt, right?
Right.
However, what I would tell you is that if you don't need forbearance, don't take it. It's not like it's only going to be available right now, right? So if you don't need it, and and you still have a job, you still are getting your income and all of that, just keep it over there as the break in case of emergency option in case you do get laid off or something of that nature. On the other side, with forbearance, if you do need it, and this is the difference between paying for food and healthcare and other necessities in life, then absolutely do take advantage of it. If you've got questions about it, I could go on literally for like a half an hour on the details of this. If you've got questions about it, let's have our own private sips and tips. Let's cry into a beer together about this and find you a solution that helps you keep the runway of keeping your home as long as possible. Hopefully that's a fair answer there, enough detail that gets
Sounds
us
good.
going.
Thank you.
Any other questions?
Hi, Jamie. Can I ask about, I've been hearing that not everyone is offering FHA loans anymore. Is there any truth to that, or what do you know?
No, I think FHA is as far as I know, it's just fine. I haven't heard of anything that would prohibit or make more difficult FHA loans. I think it's actually the opposite. Is probably what you're hearing from people who aren't clarifying. It's essentially any government-backed loans are gold for lenders right now, right? Because what lenders want is they want insurance for risk, right? And if that insurance comes from the government, then they're all over it, right? If you start to get into private mortgage insurance, that's where things get a little bit more expensive and harder to get to, right? Because those companies are trying to mitigate their risks at a higher level. Does that make sense?
Yes, sort of.
Yeah.
I just hear that, like, the credit scores and things are going upwards for FHA to qualify, even though FHA has like a true minimum, that lenders actually have a different amount that they're going for, and just how much is that changing? And
I believe we have already hit peak conservatism when it comes to government-backed mortgages, right? And what I mean by that is, like, almost instantly when the market started to change and the mortgage market started to change, you saw a great deal of volatility with rates, and this just kind of sent the mortgage market. I mean, it was, again, just for nerds, it's one of those, if you just look at the numbers, it was just wild, right? And right after it was super wild, we ended up with this conservatism where, boom, almost overnight, credit scores jumped, qualifications jumped, all of that. And what ended up happening is the government stepped in and said, well, no, this isn't really what we want to have happen. And so they've started to decrease that, right? Is it more difficult today to get a mortgage than what it was a year ago? A little, but not hugely, right? It's not like you have to have 800 credit scores or anything like that. I think the last that I heard on some federally backed products, you're looking at like minimum credit scores of 650, 680, something of that nature.
okay.
Did you have follow-ups, Kim?
Nope, I'm good with that. Thank you.
Awesome. Cool. Any other questions about just overall market conditions? Awesome. All right. Well, I'll get on to improving your home. I know that one of the things that we've seen, at least in our own life and in talking to so many friends and clients, is that when you're at home, once you've watched all of Netflix and all of Hulu and all of that, suddenly you start to bring out the tool belt and say, what can I do to make this home a little bit nicer? So I'll go into the 2020 wish list. I thought this was interesting when I was kind of researching and just kind of updating my head about what's latest and what's new. There was a recent study done that basically went out and asked for those folks who are going to stay put, what's their wish list for what they could do to their home? How can they make their home a little bit different, just to be more satisfactory to them, right? And you can see here, more space, more natural light, a home gym. Certainly we've seen that. One of the things that I've enjoyed is watching the prices of dumbbells go up. I don't know if you've ever seen that. I was shopping for some like back in January, and a set that I could have bought for $150 in January was like $1,500 in April. It was nuts, right? So a home gym, add a bathroom, and I would probably say add a bathroom. The other word that you can add, could update here is to update a bathroom, right? Updated kitchen and larger yard and patio, right? Anything else that people are wishing for out there, or does this kind of hit all the major points?
Home office?
Home office, yes, exactly. And we're going to talk about that a little bit later as well. Yeah, so home offices. Trying to think of anything else that I've heard. Jerry, Annalisa, anything that you've heard that are not in this list of when you're talking with buyers about what they would like to see in their next home that they don't already have?
I think that the master bath is always a conversation. So between living in Seattle up to Edmonds, where we're looking at, the average $700,000 Rambler that doesn't have a master bath, they do not want to shower with their kids anymore.
Yep.
So as long as it's done successfully, because I think that some people are just jamming it in there, and with a sink that's, I'm not joking, 7 inches by a foot wide. We have been seeing just comical